Hi everyone and welcome to CSC Canadian Securities Course Level 2 exam prep. So this video is about numerical questions that you are going to come across. So I have divided the entire level 2 into 2 or 3 parts. In the first part, that is this part, we are going to cover chapters 13 to 19. So we are going to discuss all the numericals that you could come across in the final exam, right? From chapters 13 to 19. In the next part, we are going to discuss chapters ahead of 19. Okay. So what I'm going to do, each question I am going to read and then solve, but I would request you, if you're practicing at home, for each question you pause the video, go and try your own solution and then check my solution, the solutions that I have provided. Okay. So let's start with it. So the first question is about trends. This is very likely it is very likely that you will get questions like this, right? So the question is about calculating the trend. So calculate the trend for year 3 for following earning per shares numbers. Round your answer to the next 2 decimal places. So what have they given? They have given years 1 to 5 and they have given some EPS numbers. So 2.12, 2.8, 1.9, 2.2 and 2.1, and they're asking you to find the trend. Now, how do you solve such questions? So let's look at the solution. So the solution is year 1, you always assume to be 100. So year 1 EPS 2.12 is going to be 100. So assume year 1 to be 100. Then every other year you represent it in terms of base year. So every other year it's going to be current year, right? Current year's EPS number divided by base year's EPS number into your assumed number 100. For example, for year 2 it's going to be 2.8 divided by 2.12 current year divided by base year into 100. For year 3 it's going to be 1.9 current year divided by base year 2.12 into 100. For year 4 it was going to be 2.2 divided by 2.12 into 100, and year 5 it's going to be 2.1 divided by 2.12 into 100. So the trends that you're getting, these are the trend numbers. This is the trend. So trend is 100, year 1 always 100, we assume it to be 100, then 132, 89, 103 and 99. Now in the exam, be very careful which year is year 1. Sometimes it's reverse. So year 5 could be year 1. So that is, they represent it left to right or right to left. So please be careful which is the year 1 that you have to assume to be 100. That's where you can go wrong in the exam. So they're asking you third year's trend. So it's going to be 89.62. Two digits round up. So it's going to be 89.62. Year 3 trend. Okay, that's the first question. Next type of question, right, that you will come across is portfolio returns. Again, very important concept, you're likely to get it. So portfolio is equally allocated to 4 securities. A security A has an expected return of 14%, security B has an expected return of 12%, C 8% and D is 5%. Calculate the expected returns on the portfolio. Now how to do such questions? So portfolio returns are always weight of investment into return of that investment. So weight of that investment into return of that investment. So you're making investments across 4 stocks, right? A, B, C and D. So it is A, B, C and D, right? Their returns are given. So note those returns down: 14, 12, 8 and 5. Then weights are not given directly, but they are given indirectly. You have been said that your portfolio has an equal weighting. Your portfolio has an equal weighting. That is, there are 4 stocks. So each stock has a weighting of 1 by 4. That is 25%. Each stock has a weighting of 1 by 4, that is 25%. So you have returns, you have weights. The next part is calculating portfolio returns. So what is the formula for portfolio return? It is return of A into weight of A plus return of B into weight of B plus return of C into weight of C plus return of D into weight of D. So it's 14% into 0.25 plus 12% into 0.25 plus 8% into 0.25 plus 5% into 0.25. So that comes to 9.75. So your portfolio returns, the answer is 9.75% returns. Okay, this is portfolio returns question. Next one is portfolio returns, right? A variation of the previous one. You have 5 securities now. The returns are given. So 9% on A, 3% on B, 6% on C, D has 5%, E has 7%. Now, instead of equal weight, they have given weight separately. So calculate the expected returns on the portfolio. If the weight of security A is 20%, weight of B is 30%, weight of C is 10%, D is 25%, and E is 15%. So this is one variation of the previous portfolio returns question that you can get. Instead of having equal weights, the weights are given separately. Okay, same process. Now there are 5 securities A, B, C, D, and E. You can note down the returns 9, 3, 6, 5, and 7. Now weights are not equal, so you have to note down the weights too. So it's 20%, 30%, 10%, 25%, and 15%. Next is you calculate portfolio returns by using the formula. It is returns of A 9% into returns of weight of A, returns of A into weight of A 9% into 20% plus returns of B into weight of B 3% into 30% plus returns of C into weight of C, returns of D into weight of D, return of E into weight of E. So you calculate the weighted average return, that gives you 5.6%. So this is the second variation of question on portfolio returns that you can get. So weights are given separately. That is question number 3. Answer is 5.6%. Next is rate of return calculation. So what's happening? Harry has purchased 100 ABC shares for a price of 130. 3 months later, the shares paid a dividend of $5, and then Harry sold all his shares for 180. Calculate Harry's return on common shares. So he bought it at 130, got a dividend of $5 and sold it for 180. You have to calculate rate of returns. Now how do you do it? Rate of return formula is future value, the value that you have sold it for, plus the dividend, divided by invested amount, the amount that you have bought it for, minus 1. So it will be 180, the price, selling price, plus $5 dividend, 5, divided by 130, the bought price, minus 1. So it's 42.31. So answer to this is 42.31. Next, rate of return. It is a TSX composite now, S&P TSX composite. The index goes up 3%. The equity fund has a beta of 1.3. Calculate the expected change in equity fund. So this question is about rate of return on your stock or on your portfolio based on index returns and the given beta. Now you have to always remember what is beta. So coming to the concept part, beta is nothing but the sensitivity that the portfolio or the stock has to the overall market. So your fund has beta of 1.3. So it is more sensitive than the TSX index. So how do you calculate the actual returns though? The actual returns are movement of stocks or movement of portfolio equals to beta times movement of index. So it is 1.3 beta of your portfolio times the movement of index 3. So it comes to 3.9%. So if the index moves 3%, based on the beta that your portfolio exhibits, you are most likely to have 3.9% movement in your stocks, in your portfolio. Okay, that was question number 5. Let's go to question number 6 now. this is about real returns. So the impact on inflation, very important concept. So very likely to be tested, especially these times inflation is so high. So everyone wants to generate real returns, but it's getting harder and harder to generate those real returns. Okay. So coming back to the question is calculate a client's nominal returns if she earns 3% real return on an investment in a period of 2% inflation. So the real return is given, inflation is given, you have to calculate nominal returns. Now you have to remember this formula for the exam, and you have to modify the formula based on what is asked. So the formula is real returns on any investment equals to nominal returns that the investment is providing minus the inflation. Okay, so real return is nothing but returns you generate minus whatever inflation is there in the market. Now they have not asked real returns to you, they have asked nominal returns. So if you rearrange this formula, it becomes nominal returns equals to real returns plus inflation. So that comes to nominal returns 3% plus inflation 5%, right? Or other way around. So inflation was 3%, I guess. No, nominal returns was 3%, inflation was 2%. So this should be 2%. Okay. So real return 3%, inflation 2%. So nominal return is real plus inflation. So it is 3% plus 2%, that gives you 5%. So the answer is 5% on this question. So there was a typo, it's not 8% inflation, though we are having 8% inflation right now, but in the question the inflation rate was 2%, so it's 3% plus 2%, that gives you 5%. Okay. Next one. The next question is about ex post and ex ante return. So what's happening? So Sharjil purchases an equity fund for $22 per unit, anticipating that the unit value will increase to $35 by the end of the year. Instead, the fund value actually increases to $34, but he receives 0.75% in dividends for each unit. Calculate the most likely ex post returns that he has received. Now there are two kinds of returns, ex post and ex ante. Ex post is the actual returns that your investment has given. So you will use actual numbers. Ex ante returns means the anticipated returns that you believed that you are going to get. So you will use anticipated numbers. So in the exam, please make sure what is asked. In this question, ex post returns is asked. So we are going to calculate ex post returns, but if ex ante return is asked, you will calculate ex ante returns. So what's the difference? So ex post returns are returns using actual numbers or actual returns. So how do you calculate that? So the stock goes to $34, right? He invested it at $22 and he receives a dividend of 0.75. So the formula is, we discussed it, the selling price or the current price 34 plus dividend 0.75 divided by invested amount 22 minus 1. So please note, I'm using the actual numbers. Ex post is actual returns, right? So actual returns were 22 to 34 plus 75 cents of dividend. So 24 plus 0.75 divided by 22 minus 1. So his ex post returns are 57.95%. What are ex ante returns? Not asked in this question, but likely to be asked in the exam. So if you are asked ex ante returns, it's going to be using anticipated amount. So same formula, like estimated amount FV plus dividend divided by invested amount minus 1. So it will be, he expected the stock to be at 35 and he did not expect any dividend. So 35 plus 0 divided by 22 minus 1. So that comes to 59.09. So in the exam, be very careful about these keywords. Ex post, you use actual numbers. In ex ante, you use anticipated numbers. Okay. So that is question number 7. So in total, there are 26 questions. So we are already done with 7 questions. I hope you're pausing the video and then trying to solve it. Next is rate of return calculation. So an investment portfolio has a market value of 20,000 as of January 1 as a result of $4,000 in capital gains and $6,000 in investment income, the portfolio has a market value of $30,000. Calculate the total returns on the portfolio. So total returns are always the capital gains plus investment income, right? So simply it is the value of the fund right now, 30,000, divided by value when you invested, 20,000 minus 1. So portfolio returns is simply future value divided by beginning value or invested value minus 1. So it will be $30,000, the value right now, divided by $20,000 minus 1. So it comes to 50%. Okay, so the answer is 50%. Next, the client portfolio has a January 1 market value of 102. The client contributed an additional $11,000 to his portfolio and ended the year with portfolio value of 125. Calculate the total return on the portfolio that comes from return on investment and not from new contributions. So if you read the question very carefully, you had $102,000. You additionally contributed $11,000, right? And the portfolio grew to 125. So some returns are coming because the value of your investment went up. Some returns are coming because you put in some additional money. They want to know how much returns did actually come from value of investments going up. So how do you solve this? So they are asking returns from growth. So it is future value, right? Whatever is the fund value divided by beginning value plus the yearly investment you have made minus 1. So if you calculate that, so it is $125,000, the value right now, divided by $102,000 value at the beginning of the year plus $11,000 of yearly investment minus 1. So that comes to 10.62%. So you actually made a return of 10.62%. Now please be careful. Returns from growth, you have to add the yearly investment in the denominator. Okay. Next, very important concept, Sharpe ratio is present all throughout this level 2. So it comes across multiple chapters. So very likely to be asked questions about Sharpe ratio. So they're asking, calculate the Sharpe ratio for XYZ investment fund, which has an average return of 8%, a standard deviation of 3%, and a risk-free rate is 4.5%. The benchmark return is given 7%. So Sharpe ratio is returns that are adjusted for risk. So formula for Sharpe ratio, let's see what it is and solve it. So formula for Sharpe ratio is portfolio returns, whatever you have received, minus risk-free rate divided by standard deviation of portfolio. Now in the formula, if you see, there is nowhere that benchmark comes in. So benchmark in this question or in the final exam will be just given to confuse you, but there is no point of using benchmark returns anywhere. Okay, so Sharpe ratio will be portfolio returns 8%, right, minus risk-free rate 4.5% divided by standard deviation of portfolio 3%. So it will be 8% minus 4.5% divided by 3%. So that comes to 1.166. Okay. In the exam, please be careful. Anything to do with benchmark not to be included in the Sharpe ratio calculation. Like even if they give standard deviation of benchmark or returns of benchmark, like you just have to ignore it. Next is taxes, right? So what's happening? An investor purchases XYZ unit in a non-registered account on December 20 at an NAV of $40 per share. On December 30, the XYZ pays a capital gain of $5 and the NAV falls to $34. Calculate the investor taxes payable per unit if the marginal tax rate is 32%. So the taxes that you pay depend on what kind of distribution you're getting from the fund. So if it is a capital gain distribution, the treatment will be different. If it is a dividend distribution, the treatment will be different. And if it is an interest-based distribution, the treatment will be different. In this case, they're giving that you have received a capital gain of $5, right? So you have to pay taxes on that capital gain dividend of $5. Now how to do that? So you have received a capital gain of $5. Now, right now, only 50% of capital gains are taxable. So out of this $5 gain you have received, only $2.50 will be taxable. Out of this $5 gain that you have received, only $2.50 will be taxable. So this is the taxable capital gain. Now the tax rate given to you is 32%. So you have to pay 32% taxes on this $2.50. So the taxes comes to $2.50 into 32%. So that comes to 80 cents, $0.8. That is the taxes you have to pay per unit. Okay. So in the example, please be careful which kind of gains is given, capital gains or interest or dividend. Next one. An investor purchases 500 units of a no-load fund for $12,000. In year 1, he receives $3,000 in dividend. In year 2, he receives $250 of dividend. In year 3, he receives $500 of dividend. All the dividends are reinvested in the new share of the fund. In year 3, he sells all his units for $40,000. Calculate his capital gain. So this is a case of dividend reinvestment. This is a case of dividend reinvestment. So what happens when a mutual fund gives you dividend? In whatever year you receive the dividend, you have to pay taxes. But since you are paying taxes on the dividend you are receiving, you get to adjust the cost basis. So whatever dividends are reinvested, right, that increases the cost of acquisition. So this $3,000, $250 and $500 is going to increase the cost of acquisition. So let's see how to solve such questions. So this is the question. Sales proceeds, first note it down, $40,000, that's given to you. Okay, now we need original purchase price, that was given to be $12,000, and we need to note down or add up all the reinvested dividends. So original purchase price was $12,000, you got some dividend, paid taxes on it and reinvested those dividends back into the fund. So this is the total amount, 3,000 plus 250 plus 500 of reinvested dividend. So what does that reinvested dividend do? It increases the cost basis. So instead of $12,000 original cost, you can now show in your tax reports 15,750 as the cost of acquisition. How do you do that? So it is $12,000 plus 3750, that is 15,750. So this is the cost of acquisition. So capital gain is always sales proceeds minus adjusted cost basis. So it is $40,000 minus 15,750. So that comes to 24,250. So the capital gains in this case is 24,250. That is question number 12. Next one. The next question is based on withdrawals. So an investor holds $70,000 of a mutual fund and enrolls in a ratio withdrawal plan with an annual withdrawal of 18% per year at the beginning of each year. Assume that the first withdrawal takes place at the beginning of year 1 and the fund grows by 5% per year. Calculate the amount that can be withdrawn in the second year. So this is the question of ratio based withdrawal. So you have certain investment. You're going to withdraw certain amount from it. Now rest of the amount gets invested and it grows. That becomes next year's fund value and you again withdraw a certain percentage from it. So how will that work? So let's see. So this is how you solve questions like this. So fund value at the start, always note it down. Then you make withdrawal. The withdrawals are 18% of the fund value. So that you have to make a column for that. Then funds that are left after withdrawals. So whatever funds that are left after withdrawals, you note that down. And funds that are like value at the end of, like those leftover funds are going to grow. So the fund value at the end, assuming a 5% growth. So these are the columns that you have to prepare. So let's see how it will work. So you start the fund at $70,000. You make 18% withdrawal on that. So withdrawals are $70,000 into 18%. So that is $12,600. So how much funds are left? $70,000 you started with, $12,600 you withdrew. So $57,400 is left. Now this $57,400 is going to be invested at 5%, so it's going to grow. So the growth that you get is 57,400, this cell, into 1 plus 5% because the growth rate is 5%. So your fund is going to be 60,270. This 60,270 becomes next year's starting value, out of which you withdraw now 18%. So 18% you withdraw. So $10,848 you withdraw. Then what is left? 60,270 minus 10,848, 49,241 is left, right? That gets invested at 5%, so it grows. So 49,241 into 1 plus 5%, 51,892, and this will continue to go. Now they have asked you second year withdrawal number, so the highlighted number 10,848 is the answer. So this highlighted part 10,848 is the answer for 13th question. This is a question based on ratio based withdrawal. Next, withdrawals, right? Again, questions on withdrawals. So they are asking you calculate the amount of withdrawals based on life expectancy adjusted withdrawal plan if the value of the fund is 233,312, life expectancy is 89 and the current age is 72. So this is a question on life expectancy adjusted withdrawal plan. Now how to do questions like this? So there is a formula. So withdrawals based on life expectancy based withdrawals is given by fund value divided by life expectancy minus current age. Fund value divided by life expectancy minus current age. So it's going to be 233,312, the fund value at the start, divided by 89 minus 72. 89 life expectancy, 72 current age. 89 was life expectancy, current age was 72. So that gives you $13,724. So very likely to get questions, one questions at least based on withdrawal. More probability for ratio based withdrawal or life expectancy based withdrawal. Please note, life expectancy based withdrawal, there are few more questions that you can get. For example, what happens if life expectancy goes up? So if life expectancy goes up, the withdrawals are going to go down, because if you increase the denominator, right, the ratio falls. Okay, what happens if the current age goes up? So as the current age goes up, the withdrawal are going to rise. Okay, so a few things to note. Next one, dividend reinvestment. So at the beginning of the period, the fund value was $1 million, right, with 500,000 units outstanding. So the fund value of a mutual fund is given $1 million and 500,000 was outstanding shares. The fund paid a contribution of $90,000 which was reinvested. Most likely the fund generated how many additional units? Now what's the concept? So you have a fund that pays out certain distribution. So whenever a fund pays out distributions, the NAV of the fund, the net asset value of the fund, will go down by the distribution amount. So the NAV is going to drop. Now you receive this distribution and the distribution then gets reinvested. So this $90,000 distribution gets reinvested into the NAV, but at the reduced NAV. So you generate some additional units. So let's see how will that work. So the fund value is 1 million. The number of units you have is 500,000. The first thing you have to do for solving questions like this is calculate the NAV. So NAV is nothing but fund value divided by number of units. So it is $1 million divided by 500,000. So $2 per unit. Then the distribution was paid $90,000, right? So this distribution is going to drop the NAV. So how much is distribution per unit? So $90,000 you got for 500,000 units. So $90,000 divided by 500,000 units. So that is 18 cents per unit, $0.18 per unit. So we discuss NAV was 2. You get paid distribution of 18 cents per unit, so your NAV is going to drop. So what is the new NAV after distribution? The new NAV after distribution is $2 minus 18 cents of distribution, so $1.82. $2 NAV minus 18 cents of distribution, so $1.82 is the NAV. Okay, now this is the new NAV after the distribution happens, but distributions you're not taking in cash, you're reinvesting back into the fund. So this $90,000 gets reinvested at the new NAV. So you will generate some additional units. How many additional units do you generate? So it is $90,000 getting reinvested at $1.82. So it is 19,000 divided by 1.82. So you get 49,451. So the total units that you generate are 549,450, right? You had 500,000 units initially, plus you generated additional units of 49,451 because of reinvestment. So the new total that you have is 549,450. So this, you generate some additional units, almost 49,000 additional units that gets added into the unit count. So this is how reinvestment dividend works. So you will calculate the NAV. The NAV will drop because distribution is being paid. So distribution per unit is calculated, the dropped NAV is calculated, then the distribution gets reinvested at the new NAV. So 90,000 divided by 1.82 gives you 49,451. That was your answer. New units that are generated. Total units, if they ask in the exam, it will be original units plus new units generated. So it will be 549,450. Again, a dividend reinvestment question, but a variation of it. Instead of the fund level, you're calculating it at the investor level. So what's happening? So $1 million, the fund value, 500,000 units. The fund paid a distribution of 90,000, which was reinvested. Now, this was the total distribution for the fund. Mr. A did not hold the entire $1 million, right, of fund value. He had $20,000 invested in the fund. What is the most likely the fund generated how many additional units for the investor now, not for the fund? So how do you do such questions? So it's a variation. So some process is similar. So NAV you have to calculate. So 1 million divided by 500,000. So that is $2 per unit. Distribution was paid 90. So you have to calculate distribution per unit 0.18. Then the NAV is going to drop. So from $2 it is going to $1.82. So that drop is going to happen. Now we come down to investor level. So the first part is similar to question 15. The investor level part. So he had invested $20,000. So total units that he had was 20,000 divided by $2, that is $10,000. So on this 10,000 units that he have, right, he got some distribution. How much was the distribution? 18 cents per unit. So he is going to get 10,000 units into 18 cents per unit, that is $1,800 of distribution. This $1,800, right, is paid to him, but that gets reinvested back into the fund. So this $1,800 is going to be reinvested at the new NAV 1.82. So 1800 divided by 1.82, that generates 989.01 as the answer. So additional units are 989. The investor had 10,000 units already. He generates 989 additional units. So he ends up with 10,989 units. So this is the answer, 989 units. So this is another variation that can be asked in the exam. Okay. So please note, like these two questions are little difficult to understand because I'm not explaining the concepts behind it. I've already done it in the concept videos. So this is just a practice video for all the numericals that you might get in the final exam. So revisit the dividend reinvestment concepts, pause the video, solve it again, start to think how it is working, and then apply it. Okay. I have shared the link of this Google slide as well as the Google Doc, right, the Google Excel sheet in the description of this video, so please check it out. Next one is NAV calculations. So the fund has 13 million in assets, 1 million in liabilities, and 1 million units outstanding. The NAV per share would be, so how do we calculate NAV? So NAV calculation, asset value is given 13 million, liabilities are given 1 million, units outstanding are given 1 million. So what's the formula? The formula is assets minus liabilities divided by total number of units. So it is 13 million minus liabilities 1 million divided by 1 million. So it comes to net asset value of $12 per share. Net asset value of $12 per share. So that covers question number 17. So we are almost there. So 9 more questions to go. So let's start with question number 18. Question 18 is about mutual fund fees. So what's happening? An investor purchases 10,000 units of a mutual fund with a 5% front-end load. Calculate the actual amount invested. So 10,000 units of a mutual fund, right, he has purchased. There is a front-end load fee of 5%. Now there are two kinds of mutual fund fee structures. Front-end load are applied when you buy the mutual fund. Back-end load or deferred sales charge are applied when you sell the mutual fund. In this case, they are asking you the impact of 5% fee. So how do you solve it? So they are asking you actual amount invested. So you invested $10,000, but out of that 5% went to fees. So 10,000 into 5%, $500 went to fees. So how much actual amount was invested? 10,000 minus 500, $9,500 was actually invested. Again, continuation of mutual fund fees, but now it is back-end fees. So back-end fees apply when you sell the fund. So calculate the redemption price of a mutual fund with a NAV of $30 per share and a 3% back-end load calculated on NAV at the time of redemption. So how will it work? $30 you are selling the fund for, but there will be fees that you have to pay when you sell the fund. The fees are 3% of $30 because it is NAV at the time of redemption. So you're going to get less amount than $30. Let's see how to calculate the actual amount. So NAV was $30. Back-end load given was 3%. So what is the redemption price? Redemption price is $30 minus $30 into 3%. So $30 minus fees on it. Fees on it is $30 into 3%. So it is $30 minus $30 into 3%, which is the fee part. So you get $29.1 per unit. Rest of the 90 cents goes towards fees. This was back-end load. Next, again, fees part. Calculate the offering price of a fund with a net asset value of 30 and a front-end load of 3%. So the mutual fund is priced at $30, but you're going to pay fees on top of that. So if you're paying fees when you buy, front-end load is when you buy, your cost of acquisition is going to be higher than $30. So how do you calculate the actual cost of acquisition? So it is NAV $30 given, the front-end load 3% given. So NAV after the front-end load, it's going to be $30 divided by, this should be 1 minus 3%. So it is 1 minus front-end load. So it is $30 divided by 1 minus 3%. It comes to $30.92. So the fund was charged at $30, price was $30, but you pay fees on top of that. So your cost of acquisition after the fees, it's a little bit higher than 30. So it's $30.92. How did I get this? So the formula is NAV before fees divided by 1 minus front end load. So it is 30 divided by 1 minus 3%. That comes to 30.92. Next, a mutual fund with 600 million in asset has a total annual expenses of 10 million. Its management expense ratio will be what? So $600 million asset value is given and a total annual expenditure of $10 million is given. They are asking you to calculate MER. MER is calculated as, so let's see how. Assets 600, annual expenses 10. MER is nothing but expenses divided by assets. So expenses are 10, assets are 600. So it is 10 divided by 600. It comes to 1.67%. So management expense ratio in this case is 1.67%. Okay. Next one. Mr. A invested in a Scotia mutual fund when the NAV was $12. After 3 years, he sold the fund at $16. If the fund charged sales deferred fees of 4% on the purchase price, what would be the selling price after the back end load? Now what's happening? You bought it at 12, 3 years you waited, you sold it at 16. But the fund is going to charge you 4% fee. Now this sales deferred fee back end load can either be charged on NAV at purchase or NAV at sales. In this case, it is charged on NAV at purchase. NAV on purchase. So what would be the impact on that? So let's see how to do it. So $12 is the NAV at purchase. $16 is NAV at sales. Sales deferred fees are given 4%. So what is NAV at redemption? How much do you actually get in your pocket? So it is given as $16, the selling price, minus fees. So $16 minus 4% on 12, because the fees are charged on the purchase price in this case. So it is 4% into 12. So it comes to 15.52. So NAV at the time of redemption in this case is 15.52. Next one. Mr. A invested in Scotia Mutual Fund when the NAV was $12. After 3 years, he sold the fund at NAV of $16. If the fund charged a sales deferred fee of 4% on the redemption price, what would be the selling price after back end load? So this one again, the redemption price they're asking, but the deferred fees are charged on redemption price instead of purchase price. So similar question, a twist is given. Instead of 4% being charged on $12 purchase price, 4% is charged on $16 NAV at the time of redemption. So how do we do that? So same thing, NAV at purchase 12, NAV at sale 16, 4% is the sales deferred fee. So NAV at the time of redemption is $16 minus fees on redemption price. So 4% into 16, that is $16 minus 4% into 16, that comes to 15.36. So these are the two variations on sales deferred fee. Either the fee can be charged on purchase price, which we did earlier, fees are charged on $12, or it could be charged on redemption price, fees are charged on $16. So in the exam, final exam, be very careful what they are doing. Next. The next question is about intrinsic value of a stock. So based on the following, calculate the intrinsic value of company ABC stock. The dividend paid out in the current year is 14. The required rate of return on the stock is 9% and the growth rate of dividend is 5%. So this is based on dividend discount model. So how do we solve such problems? So first of all, you have to identify whether D0 is given, that is current dividend is given, or expected dividend is given. In this case, current dividend is given. Current dividend is $14. So $14 dividend is given. In the formula, we cannot use D0. We have to use D1. The intrinsic value of a stock is based on all future dividends, not the current dividend. So we have to make an adjustment. We have to calculate D1. So D1 in this case is D0, $14 into 1 plus growth rate of dividend. So 14 into 1 plus 5%, $14.7. Then G is given 5%, R is given 9%. So you have to calculate intrinsic value based on the formula D1 divided by R minus G. So it is 14.7 divided by 9% minus 5%. So that comes to an intrinsic value of 367.5. That comes to an intrinsic value of 367.5. So in the exam, please be very careful what is given, D0 or D1. Sometimes they give you D1 directly, expected dividend or anticipated dividend. Sometimes they give you D0, in which case you have to calculate D1 first and then you will use it in the formula D1 divided by R minus G. Next one, similar question, some changes. Based on the following, calculate the intrinsic value of company ABC. The expected dividend to be paid in 1 year, $9. So they are giving you D1 directly. This is expected dividend. The required rate of return 9%, the growth rate of dividend 5%. So how do you do such questions? Easier. D1 is already given, so you don't have to calculate that, $9. G is given 5%. Risk-free rate, like required rate, is given 9%. What is the formula? D1 9 divided by R minus G, 9% minus 5%. So the answer comes to $225. So the intrinsic value in this case is $225. So in the exam, figure out D1 or D0 is given and based on that structure your response. And the last one. So rebalancing a portfolio. So Mr. A has a strategic allocation of 50%, 50% in equity, 40% in fixed income, 10% in cash. The portfolio has drifted because of asset performance and accumulated dividend and interest. The current values are equity 500,000, bond 200,000, or 500,000 in equity, $20,000 in bond, $100,000 in cash. How would you rebalance? So let me first check. Yeah, it is $20,000. So no need to worry. I thought it is 200. So it's 20,000. So you have to calculate how to rebalance. So what is this? So most investors will do a strategic allocation. So they want, based on their risk return dynamics and how much risk that they can take, they will have an allocation, yearly allocation that they set. 50, 40, 10 in this case. 50 stock, 40 bonds and 10% cash. Now, because of dividends, because of how these assets perform, the portfolio allocation is going to drift. It's going to change. Then you have to go back to the original allocation, right? So you have to rebalance the portfolio. Now, how to do that? So first of all, write down the strategic allocation. So 50% in stocks, 40% in bonds, 10% in cash. Now write down the current allocation. The current allocation is you have 500,000 in stocks, $20,000 in bonds, and you have $100,000 in cash. So this is the current allocation. This is step number 1. Write it down. Step number 2, add it up. So 500 plus 20 plus 100, $620,000 is the total money you have. Now you have to go back to the strategic allocation. So you have to divide this total money into stocks, bonds and cash based on 50, 40 and 10. So what does that mean? That 50% of 620 should be in stock. So 50% into 620, $310,000 should be in stock. Then 40% into 620 should be in bonds. So 40% into 620, 428 should be in fixed income. 10% should be in cash. So 10% into 620, $62,000 should be in cash. So this is the allocation that is based on strategy that you have made, strategic allocation. Current is different, so I have to rebalance. So changes are the strategic allocation minus the current allocation. So it will be 310 minus 500, 190 negative, 248 minus 20, 228 positive, and 62 minus 100, 38 negative. Negative value means you have to sell. Positive value means you have to buy. So changes that you have to make, you have to sell equity worth 190,000, buy bonds worth 228,000, and you have to decrease the cash allocation by investing it by 38,000. So this is the changes, rebalancing that is required. So that completes this part. So see you in the next one. Right, till then, please practice these questions once again. The Google Slides and the solutions are given in the description.